Pull the trigger.
How's it, traders, and welcome back to Paradigm Flip. Hope you're all doing well. I'm wishing you all a very happy new year. I just wanted to bring up a few things before we get started. This year, I want you guys to work hard and diligently and make sure that you go through this year each day working towards your goals. And that's very important, especially when we are trading. Trading is not a very easy task. It's very difficult, and it's gonna need everything you've got. And never give up on what you want in life. Keep pushing and striving forward and aiming towards that goal that you want. And having said that, I just wanted to bring up a few things here. Now, myself, I'm a Christian, and I believe in working hard as well. And if we just look at a Bible verse that comes out of Ecclesiastes 9 verses 10, right? It says that whatsoever thy hand findeth to do, do it with all thy might. For there is no work, no device, no knowledge, no wisdom in the grave, whither thou goest, right? So at the end of the day, it's important for us to work hard because when we die, it's all over. So it's important to make sure that we do well with with the time that we are blessed with, right? And I'm gonna quote another verse that comes from Proverbs 14 verses 23, which says, "In all labor there is profit, but idle chatter leads only to poverty." Right? So just keep those words of wisdom, right, from the word close to your heart, right? And just remember those words as we go forward throughout the year, and just keep striving and keep pushing for what you want. Okay, and just remember that there is a promise for those who work hard, right? At the end of the day, we all reap what we sow. What I wanted to be talking about today was the idea of measured moves and the importance of measured moves, right? And now, what is a measured move, right? A measured move is a sim simply a one-to-one move, right, from the consolidation area, right? So if you have a simple consolidation area like this, okay, right, or a pullback or whatever it may be, okay, a measured move is basically a one-to-one measure of the balance area. So at this point, the balance area could either break to the downside or break to the upside, right? If we're breaking to the downside, right, all we are doing is we are taking this range and we are projecting it out, right? And that projected measure is basically our measured move, right? And that's a very important concept because these areas provide good targets and also provide good opportunities when we want to trade a reversal trade or counter trend trade, right? Because these are going to be areas where we can find significant bounces, okay, and that can also be a trade opportunity, right? And if we just have a look at what we have here on the chart, we have a Euro USD on a 30-minute chart. And what I just want to do is highlight a consolidation area, which would be this area here. Okay. And I'm just going to draw that up, right? I'm just going to put a simple Fibonacci tool over that area. And what you'll notice is my Fibonacci tool, right, simply has the 100% retracement level. We have the 50 level and the level 1 area, right? And going out, we basically have minus 0.5, minus 1, minus 1.5, and minus 2, right? And you'll notice that these are all equally spaced, okay? And that's very important because all these levels will be possible reversal points, right? Going forward if we draw the Fibonacci from swing point to swing point, right, and project it out in time, right, these are going to be areas where we can look at and focus on. Now, based on this range, what you'll notice off the bat is that we simply have a measured move. So a measured move will be a one-to-one of this balance area, right, projected out in time, right, and that'll be simply this -1 level here, right? So that's a one-to-one of the range, right? And what's actually happening here is that when we have this consolidation area, right, what we actually have is an area where we have a battle of sellers and buyers in the marketplace, right? And one side is going to dominate over the other, right? And we're going to have a loser and a winner, right? It's either the sellers are going to win and the buyers lose, or the buyers win and the sellers lose, right? Because trading is a zero-sum game, right? And money is always going to be transferred from the losing side into the winning side. Okay, and that's basically what's happening in this range is basically we have a battle, right, of buyers and sellers. Now, the buyers and sellers accumulating within this range are going to be found throughout this range, right, from the range low to the range high. You will find trade at nearly every single price point, right, within this range. Okay. And that's simply because institutions can't accumulate all their position at one price point. They are going to need multiple price points, right? So we're going to have passive traders sitting at different price points within this accumulation, and we'll also have aggressive traders entering at the market within this area as well, right? And that goes for both the sellers and the buyers, okay? And once they accumulate this position, okay, and if, for example, in this case, we can see that the sellers managed to take control and took price lower, okay, once we break out of this balance area, traders are going to be looking to take their profit at a one-to-one measure of their accumulation, and that would obviously be this zone, right? So whoever is accumulating in this area is going to at least target a one-to-one, right, of this accumulation, and that's where they're going to be looking to take profit. And the simple reason for that is because this is a distribution, right, with standard deviations attached to it. Okay, so if I just take a simple volume profile and I draw it over this range, okay, what you'll notice is that we have these volume nodes, right, and basically we peak out in the middle of the range, okay, and basically where this red line is, that's telling us that we have the highest distribution at this area, right? So this is the area of highest volume, right? And this is called the POC, right? Or the point of control. And why it's called the point of control is because this is the area where price has traded the most. So the most trade was actually taken, right, at the POC or at this price point, and that's why it has the highest peak, right, within the distribution. Okay, and what this basically means is that throughout this area, right, obviously, like I previously stated, we have both buyers and sellers, right? And this area is going to be the area where we have the highest volume of buyers and sellers within the market, right? So any area above this area, right, on average, buyers are going to be in profit, and any area below the POC, right, sellers are going to be in profit and buyers are going to be losing at that point. Okay, so that's very important, and that's why it's called a point of control, because it lets us know who's currently in control within the market, right? And having said that, okay, we also have the areas where we can see that we taper out, right? So when I say taper, I mean that the distribution gets flatter here. You can see that the volume is not so great in these areas, right? There is volume, but it's not as high as the peak, right? And you can see it tapering, right, on the as we move away from the POC. Okay, and that's because there is not much volume at these areas, right? And the simple reason for that is because buyers are unwilling to buy at higher prices, right? And sellers are unwilling to sell at lower prices, okay, generally speaking, right? So we will get a taper at these areas, okay? So if sellers are unwilling to sell at these lower prices, right, then basically buyers have not enough volume or not enough liquidity to buy up. So the volume is obviously going to be lower, right? And the same thing with the buy side, right? If buyers are not willing to pay up these higher prices, then sellers don't have liquidity to sell to, right? They don't have basically buyers that they can sell their positions to or sell into, right? And therefore the volume is going to be low because we have one buyer for every seller within the market. So just to explain that, if we basically have, for example, one buyer at this price point and we have five sellers at this price point, right, then only one buyer um, is taken by these sellers, right? So you'll basically have a volume of one lot, right? If we assume these are lots, okay. But if there are two buyers in this location, right, and three sellers in this location, right, then the two lots pairs up with these three lots, right, and we have a surplus of one lot, right, and the volume is only two lots, right, because we only have two buyers, right, so these sellers can only sell to these two buyers, okay. So the volume tapers, right, as we move higher and lower within the range. Okay. And obviously that changes when we start to see volume building at lower prices. As we do here, you can see we have a distribution at lower prices, right? So sellers are now willing to trade or sell at a lower price, whereas before they were willing to sell at these prices, right? And now they are willing to sell at these prices, right? So that's a bit of a different story, and the narrative now changes, and you can see that the sellers in this area gain control. Okay, and that's what leads to price dropping lower. Nonetheless, right, that's basically what's happening within this volume profile. Now, this will be the highest area, right, of trade, and these areas will have less trade. Okay, and therefore this is basically our mean, right? The POC is going to be our mean, right? And if you just have a look at what this looks like, right, if you turn this on its side, right, basically what you have is a normal distribution, right, where you have your mean here, right, and you basically have one standard deviation out here and one standard deviation out here. All right, so this is going to be your mean, or what's known as mu, right? We'll just call it mean, right? I'll just draw that nicely. And then you're going to have one standard deviation out here and one standard deviation out on this side, right? And basically these standard deviations are going to be these areas here, okay? And this is your mean. Okay, so this is basically fair value. This is what's fair. This is what buyers and sellers agree upon. Okay, and if this is one standard deviation and this is one standard deviation, right, then if we have a measured move, right, of the range, right, basically going out, this will be two standard deviations out, right? This level will be two standard deviations out, right? And this level will be three standard deviations out. Right, and obviously this level will be four standard deviations away from the mean. Right, and this is really important because if you understand standard deviations and statistics, right, I'm not going to go into all of that. I've created other videos on that, so you can search my YouTube library for more information on that, right? But when we have a normal distribution, right? And we get two standard deviations away from the mean, right? There's a high probability that price will revert back to the mean, okay? Or there's a less likely chance that price will keep on moving lower, okay? Not to say that it can't, but there's a less likely chance, right? And at the end of the day, we are playing probabilities, right? So you want to play the probability that price is going to revert back to the mean when it's overextended. So when we see that price breaks out at this point, right, we understand that if we reach three standard deviations, right, away from the mean, which will simply be a measured move away from the balance area, right, this is an overextended area, right, and we will most likely find buyers coming in this area. Okay, and anyone who has accumulated within this balance area is most likely going to take their profit at this area because it's less likely to continue lower. Not to say that it can't, right? But they're not going to leave that. They're not going to take that chance and leave all their profit on the table, right? They're going to take their profit. Okay, and buyers are also going to step in at three standard deviations, and that's because price is extended away from the mean, right? And at this point here, because you have a whole lot of buyers and a whole lot of profit taking around this level, you can expect a reversion trade back to the mean, okay, or at least a bounce. Okay, right. All that profit taking and buying should at least create a bounce within the marketplace, right? And you can see price indeed at this point does bounce and return very close to the mean where it continues lower, right? So you can find some really great reversal points using this concept, right? And the concept is fractal. It's not limited to a specific time frame, right? Whenever you do get a consolidation or a pullback or a balance area, right? And you are either taking the continuation trade. So if you are going to take any momentum or trend following trade within this area, right, a good profit target would be a one-to-one measure of the balance area, right? Or if you are looking to trade a mean reversion trade or a reversal trade, right, this is a good level to deal from. And all you are looking for, right? If you are going to take a reversal trade at this area, when price reaches this area, all you are looking for are trapped traders, right? Now, I've also done a trap trader video. You can go and have a look at my YouTube for that, right? I'm not going to get into it too much, okay? But when we see price reaching into this level, right, all we are simply looking for is a rejection, right, of a previous low, right? And you get that at this point, right, you can see that price trades below this low, right, at this point here, right, we move below this low and we reject that area, right, and once we reject that area, right, we know that any sellers in this area are now trapped, okay, we break structure at that point, right, and you can see prices consolidating within this area. You can see buyers are now coming in at these higher prices, right, and price takes off to the upside. Okay, and that would be an example of how you could find a reversal trade at these areas. And you can actually just go back in time and backtest this for yourself, right? If we move along forward, right, and we just draw a Fibonacci over this balance area from this balance area high to this balance area low, right? You'll see that when price breaks out, right, we reach a one-to-one area at this point here. Okay, so that will be that area. We just come short of it. And you can see in this area what you're looking for again, right, is a simple trap. Okay, and we get that here. You can see that we had this pullback here, right? Sellers tried to come in, okay, and they basically failed to take it any lower, right? So these sellers in this area basically haven't had an opportunity to take their profit, right? So when price comes back inside the range, right, these sellers are now trapped, okay, and that's going to be an opportunity to potentially take the market higher, right? And you get that nice bounce, okay? And we can go further. We can see future prices and see what happens, right? Here's another balance area, right? And we can draw our Fibonacci over this pullback here, right? And we just put our one-to-one target there, and you can see that price is basically within this balance area here, right? And we break out and price reaches a one-to-one, and you can see that price bounces at that area almost perfectly, right? And we revert back to the mean, right? And you can also see at this area it's the same pattern, right, of trapped traders, right? You can see buyers came in here, sellers came in, tried to take the market down. You can see they couldn't take it any lower, and when price comes back within this range here, right, at this point, right, when price comes back within the range, right, we have trapped sellers within the market, and you can see at this point price breaks market structure, right? We get that pullback, right, and price continues higher, right? And we got a nice bounce there, right? And that's a very nice little trade there that you could have captured, right, just by using this concept, right? And having said that, right, we would have concluded the video now. I encourage you to go and test this out for yourself and back test this. And if you enjoy using this here, you can add it to your tools in your trading. Okay, and I hope you learned a lot. And until next time, I'll catch you all on the flip side.